Hello there, traders. Welcome back to TOGS episode 35 of season 2 of the TOGS Trading Podcast. And thanks to all of those of you for joining us. TOGS Trading Podcast is really the sort of insight, or maybe you call it the rambles of a pair of old traders, sort of giving you a little bit of insight into what trading life is really like compared to some of the nonsense that you see on social media. Today is our last session for 2024, but not the last one of TOGS season 2. But we're here to do our little review of 2024, the good, the bad, and the ugly of this year. So there's plenty for us to talk about and discuss as always. I'm joined by Big Ian there in Dublin. Looking good, Billy Ray. How you doing?
Very much. In fact, I was just looking at myself there in the camera thing, and I'm desperately happy I have a haircut booked for Friday.
Oh, have you? Yeah, I had to have one yesterday. I was looking a little bit feral. Is that probably the closer word to the truth and stuff?
No, it's just started looking more and more Santy every.
Are you still going to that Brazilian lad in Temple Bar who you told me to go to, and it's like 60 euros for a haircut, and that was about 6-7 years ago.
Well, it was 50 actually, and it was no. He moved off. He went over to Adrian was his name, and he was a genius. So he was. He could do things with my hair that were just amazing.
Right. Well, there you go.
I mean, I've had people in my family die, and I miss my barber more. Basically, he was more used to me than a lot of them. He moved over to the UK. He's So he's someplace I'd say London or something, wherever they are, lucky to have him.
I'm surprised you've not hunted him down and kidnapped him and brought him back and stuff. But it was, for a haircut trim. I don't think I've ever paid. I don't think I've ever paid that much. I'm like, it's normally like 10 to 20 quid. All right, okay, but it was like 60 euros. I mean, he did a fair enough job and stuff. And what have you got? Fair play to him and stuff. But yeah, it's still crinkles. There's still a part of it that just crinkles.
Yeah, but it's a different thing because I don't pay the money for the hair. It's the beard that's the real thing for me. Because if you went back, when I have a beard since I was 21, 2, something like that, except for one brief period where I shaved in my late 30s for a week, and it's back in the old days they didn't know how to do beards because nobody had beards, and then the big hipster thing came, and we started getting people who actually could cut a beard properly, and that's really what I pay the money for, is the beard, rather than get a haircut. You can get a haircut anywhere for a tenner, it's not a big deal. In fact, the whole way through the pandemic, I just shaved my head, and it was as happy as anything with that. But it's the beard I pay the money for. Yeah, so I just go to a guy in Ranelagh now, and he's also 50 or 60 quid, and he's all right.
He's all right, but clearly the Brazilian barber has a soft spot in your heart. There you go.
Yeah.
So, other than paying for overpriced haircuts and beard trims, what else are you up to
at the moment?
Yeah,
it's just in the, as I was saying, I think I was saying to you or saying to somebody else, I was at a Christmas thing on Friday with my family, which and another family. We went to a Christmas walk around, and you go to little huts, and then there's a little Christmassy elves doing things in there. But unfortunately, because of the way I look, I get picked for every stupid thing that the elves would get the daddies to do. So I ended up doing things like getting a dance off and having snowballs thrown at me, and it was a bit of a burden now, to be quite honest, rather than anything else. And apart from that, not a lot else. My wife is off doing museum-y things in some place in Cork, and I'm just here on my own with my son. Well, he's in school now at the moment, but it's just the two of us, and so it's all very quiet. A lot of sitting around our underwear and farting. Basically, I think it's probably eating.
Nothing changes, Ian.
No. It's watching films and eating pizza. That's mostly, I think, our life that we're living at the moment.
So our for this is TOGS 35. So our aim for this one is a review of 2024, and really the good, the bad, and the ugly of the year. And just as an aside, it's kind of it's a practice that I encourage all traders to do. All right, get towards the end of the year, or maybe there's an end of a quarter, depending upon your own timelines, and actually spend a bit of time reflecting upon the year. All right. So last week we talked about is it worth trading during December? And thank you for those people. We got some emails and comments, etc. We always appreciate that. But as part of that, we talked about even if you're not on, let's say, on trigger time, okay, during December, there are still things you can be doing to working on your trading business. One of them being a review, a period of reflection about the good, the bad, and the ugly of the year. I normally leave it till into the last 2 weeks of December. Okay, it's like a little bit of a work escape for me. Okay, for a couple of hours to sit down and actually do it quite formally. But today is an opportunity for us to have a little chat about it ourselves. Okay, and share some of our own personal insights. So, for yourself, Ian, what's been the good, the bad, and the ugly of trading for you this year? And it can be, it doesn't have to necessarily be specific to you. It can be just about trading life and trading world in general.
Well, I suppose because of the style of trading I do, it tends to be more about me than the market in general, because I'm not that news sensitive, except for when the time comes out. I'm not really that worried about where the market's going up or going down, as long as it's going someplace. And so a lot of the things, anything that changed or whatever over the year was more to do with me. In the first place, it was kind of a normal enough year because I'm quite time poor in a lot of ways, and unfortunately, I'm time poor at times when it would be much better to be in the market. So when you have the London Open in the morning, I'm school running it, and when the 2 hours after the cash session opens in the afternoon, I'm school running it, and all that kind of stuff. And I find that. So I think I evolved over the years, over the last 8 years, really into being a type of trader who could trade for very intensely for very short periods of time. And that is great in some ways. It means that you can go in every day and generate trade, because you will almost every day, but at least 90% of the days, you're going to be able to generate something, some sort of trade. But it stagnates your growth to a certain extent, because there's only a certain amount of growth that you can actually really do with that, because you're not putting in the time. And the second problem is then you're doing these like you're doing quite quick trades, and you can't really push the volume you'd love to push or do any of those kind of things. So that was one big thing with it. I think the biggest thing really was just it's an emotional understanding, really. I think that there's two types of understanding. There's a logical understanding where you logically know that something is this way or that way, and then there's an emotional understanding where you attach an emotion with it, really, to a certain extent, or you internalize it. It's like you logically know that putting your hand in a fire is not a good idea, but you also have an emotional attachment to that idea, so you don't fight with it. And I think the biggest one that I had was that, which is very strange to say, but the simpler the trading, the better it is. Because the problem with scalping and that sort of very intense short period trading is that it's not very simple, in a lot of times, because you're having to go both ways. You might have an uptrend, but that uptrend, like yesterday, for instance, yesterday was a particular type of action. So it went from the bottom to the it went up, basically up but it didn't do it very cleanly. It went up and down yesterday. It went down more than it went up. It was just the morning, the bit that I was actually trading, there was a lot of up in it. And but it wasn't very clean. And that's that can make it a bit of a problem. So what I was basically, the idea that I came up, the thing I internalized was just pick a direction and just do the trades in that direction. That's all.
Yep.
And it makes life a lot easier. It means in some ways I have to spend more time trading, like physical time being there, which I have to free up for myself, because it doesn't generate, because you're not taking all the shorts. In a lot uptrend, you're not taking shorts. But it makes it an awful lot simpler. So, it's not as mightn't sound like a huge departure or something like that, but it's a way of making my life simpler, I think.
And that's an interesting point you don't make there. Well, a lot of interesting points, but the one I'd kind of immediately pick up on to discuss is about understanding the higher time frame bias. Okay, understanding that higher time frame bias. I think for a newer trader, that is actually probably a better thing to do, to actually pick a higher time frame bias, however you choose to do that, whether it's identifying a trend or identifying a period of liquidity or supply and demand, exactly. However you choose to do that, you can find your way, okay, but actually establishing that and then trading in that direction and using that higher time frame just as a filter to give you an insight into, right, so for this morning session, all right, I am only long yen, all right, so I'm only long yen, and then trading in line with that bias until you get price action or an event that actually confirms that bias, that trend is no longer valid, is actually not a bad way for most new traders to begin, because I think if you're trying to always play every side of the market at the beginning, it becomes very easy to become a bit overwhelmed, a bit intimidated, to basically lose situational awareness, to basically just lose perspective, and then you basically fall into a trap of either A, you're like the scared deer in the headlights and you do nothing, or you go into happy clappy mode on the other end of the spectrum and just start mashing keys and trading all sorts of nonsense and over trading your way into trouble. So I think picking for a new trader, picking a bias and trading in line with that is no bad thing. Use it as a filter. No bad thing at all as you build up your experience and credibility.
Yeah. Well, actually, newer traders are correct on. I saw some statistic on it, and newer traders are correct on direction 62% of the time. It's all the other stuff that they mess up, basically. And the thing is that if you're correct on to be profitable, you have small decision areas in the market where you can enter trades, basically. So if you have, if you're in a, sorry, I'm still getting over a cold actually. If you're in an uptrend and you have a pullback, you're going to have a small decision area where price has to make its mind up whether it's going to stall and resume the trend or it's going to continue downward. And that's what you're looking for. So if you have an idea that price has to go up and then price pulls back to support, the small support area, it's a it's a cheap way of getting into a trade, because if you're wrong, then it doesn't cost you that much because it's only a small support.
Exactly.
But if you're right, if you're right, you can sit in that trend then for the rest of the afternoon.
Totally. And if I might just add a point on that, you're absolutely right. And sometimes people don't understand it when I say it, is that doing that, like let's say buying a pullback, you're wrong very quickly. And I'd sooner know I'm wrong very quickly. I have no issue with actually knowing wrong or quickly. I'd sooner know it as quick as possible, so that I don't have any emotional capital or very little invested in it. The slate is cleaned, and then I can just review it, use that, as Mark Douglas says, just use it as a fact that I've just paid for information from the market, and then get on to the next one. There's nothing worse than having a position that just basically is just it's just doing nothing. It's just going sideways for hours, days, weeks, months, etc., and what have you. It's I'm with you totally. If I'm going to be wrong, I'd sooner know as quick as possible. I've no issue with that. I know I'm saving myself some emotional capital.
What they probably have what for newer traders particularly, and probably for most traders as well, is that they only have one bias, and that's long. Most traders are long bias traders, and they only take. Like I'm myself, I'm much more active in a long trade in an uptrend than I am in a downtrend. But the thing is that if you don't have you're right on direction 62% of the time.
Yeah.
So but you're going to cut that out. You're going to destroy that statistic if you are if you're not able to take shorts, especially in an intraday time frame. I mean, I don't think so much in like if you're out in investing in if you're out and investing in sorry, I got distracted there. The message popped on my screen. If you're investing, I think being long.
Was it from your Brazilian barber telling you how much he misses you?
No, it's from the next door neighbor about the cat.
Well,
I want a WhatsApp group. I want a WhatsApp group for there's a stray cat that lives in our neighborhood, and we've all sort of basically adopted it. It's a very low cost way of having both in time and the fact that we're all allergic to cats except my son. So my son gets the pet experience without us actually having to pet the cat. and sneeze.
Yeah.
Yeah, and the thing is, I think that people don't understand as well is that there are only two types of pullbacks. There's shallow pullbacks and there are deep pullbacks. If you have a deep pullback and that pullback doesn't pull back, then it's a trend change. It's a very simple concept, but it's a very difficult thing to
I'm with you on that. And I think probably just once again to interject, I love shorting. I absolutely love shorting. I love a short, and in fact, I'd probably say it's probably about 60% of my trades are shorts. But I caveat that with that, the majority of my work is in FX markets, so it's different from trying to short a stock. Okay, I appreciate there'll be some people here who are predominantly stock traders and they're just looking for opportunities to go long. Whereas in the FX, where you're effectively trading two instruments one against the other, going short on the instrument is not as much of an issue in any way, shape or form. But yeah, I love a short. I do. I love a good short. I really. Yeah, I love to hammer it and stuff in that way. But you're right. I agree with you that most traders, especially most traders, stock traders. They've got a long only bias, and sometimes that can count against them.
Yeah, because sometimes I think I've said this in a different podcast. I'm not entirely sure, but a lot of the times when I meet people who especially newer traders who say that they really love shorting, it's a lot of the time it's because of the emotional side of it. Because shorting tends to be more aggressive. It's dirtier, but it tends to be more aggressive, and it tends to be faster, and they get their payback a lot quicker.
Just sum me up in one sentence there, Ian. Dirty, aggressive, and fast. There you go.
So I think that's the reason why they tend to do it, because people, it's the same thing coming up to Christmas. You plan your Christmas shopping. You know where you're going. You know what you're buying. It's the same thing. You're going out buying a stock. You sit in, you stalk the stock, you read about the stock, you look at the chart, and then you plan your buy. And then suddenly it goes against you, and you go, "Oh God, I have to get rid of it." And then you press the button, and it goes, and that tends to make. And then you also as well on the downside as well, you have you have hedge funds with rules that they end up getting triggered and they have to sell stuff. So that also can happen with the.
I remember reading or being told some stock, and I could be wrong on the actual number, but something even like in a bear market for stocks, 80% of the time the market closes higher on a daily basis. Right, maybe it's not as high as 80, but it was a really surprisingly high number that made me kind of sit back and take it up at it. And then, but when you look at it and you think about it, it makes a bit of sense. Is that basically the market? It just basically in a bear market when it's going up, it's just grinding up a slight way. But when it sells off, boy, does it sell off. It really sells off and collapses and stuff. So, I suppose when you look at that, you only need, if you've got 80%, 4 out of 5 days, it actually closes higher. But on that fifth day, boom, when it sells, it really sells and stuff. And being able to position yourself or capture some of that is a skill. Right? But there you go. Sorry, I'm interjecting a lot today and stuff. Not that maybe because there's lots for us to talk about.
It shows the importance of previous day highs and lows, really, because it's in those areas that people will sit there and they will enter, like a lot of people will enter or exit trades based on previous highs and previous lows.
Yep.
I think so. It's and it does, there is that sort of grinding up, and I think a lot of the time as well that it's because the close is the most important part of the day, really. I always think anyway, because it shows the sort of the intent. If they can't close above someplace, then the trend is in difficulty. If they want to go the other way, they're probably going to close the first red bar is going to close beneath the previous day's bar at least. And it's even the same in day trading. You see it with particularly in shorting. You do see it's the previous 5-minute bar's low that really is where you're sort of looking at, to a certain extent. And I also think as well, people don't understand that pullbacks are a normal and necessary part of trading.
Yep.
They're going to happen whether the trader wants to be in them or doesn't want to be in them. They're normal. That's what proves trends.
Price never moves in a straight line. Price never moves in a straight line. There's always a zigzag to it, and being able to read that and understand that might be your opportunity to buy at a better price. If, let's say, you're a long only stock trader, or you buy it so that session was you filter if that session was long, etc. So
if you look at parabolic charts, if you look at parabolic charts, which are the fastest ones, the closest to going straight up, they're always weak. They always have this. They go up, they get back 50% of the up move.
Totally. 100%. Yeah, I agree, and I try to get that message across: is that whatever instrument, once it goes parabolic, once it starts going vertical, if you're in it, tighten up your stops. Well done. If you're on the sidelines thinking, "Oh, I should jump into this," do not. Right, because there are shorting bastards like me waiting for that to run out of energy and double top and roll over and then bang, short that bastard and stuff. And it's once price goes parabolic, and to be fair, parabolic vertically, or parabolic in a downslide. Once it does that, then basically, we're getting towards the exhaustion part of the move, aren't we?
Yeah, no, absolutely. And it's also as well, it's what people have learned, that I know even when I'm looking at massive up moves, that they're relatively weak in comparison, because the thing is as well is that it's what type of traders and what type of money it attracts in. If you have these like really quick moves up, what you're going to end up doing is it's going to attract in all of the loose money, any spare change that's out there, people have in their accounts. They're going to throw it into whatever's moving quickly. And there are people who specialize in just looking for the big movers. Those people are called amateur traders a lot of the time, to be quite honest with you, because I think that's something that can be quite because I think that a lot of amateur trading is chasing things.
Oh yes,
rather than sitting, which I think is a much better way, which is planning your strategy and then sitting in the market until your trade is triggered, and then rather than going every day and trying to see what's.
But no, I think I've mentioned this before. Okay, certainly, mentioned it in other sessions I've done, etc. Is that lots of people chase trades, but really, good traders, they are attracting trades. They are letting the good trades come to them. It's like they let the good trades come to them. When you chase anything in life, it generally just tends to run away faster from you, whether it be trades, money, women, opportunities and stuff. They just tend to run away from you faster. A good trader, like a good operator, is just effectively is you are letting the trade come to you. All right, you're letting the trade come to you. It's almost like an ambush. Almost like you're set up waiting for the price to come to your particular area where you're going to make a decision and you're ready for it. And if it does what you want to do, well, then basically you own the trade. If it doesn't, well, then, you just collapse your ambush up. If it doesn't trigger, and then you move it on elsewhere. And interestingly, years ago, I worked with, trained a guy who was a former army major, and he said that basically 70% of ambushes never get triggered. That's the kind of interesting data, and he was talking about on the battlefield. But actually, they're not always massively dissimilar to markets as well and stuff, and actually picking an area or a level that you're looking to do your business. If it triggers it, bang, you're in there. If you're not, all right, well, you don't. But you are letting the market come to you. You are attracting opportunities rather than chasing. Chasing never really works at all. Never works well.
Well, what you're going to find, the people who are chasing, those sort of amateur traders that are chasing moves, who are all probably now sitting there with their blood boiling if they're watching this, is that they're not using setups. They're trying to use momentum to make up for the fact that they're not using an actual setup. At the end of the day, now people have momentum setups. That's a different thing. It's just that they're switching on the computer in the morning. They're going to their search thing which says biggest movers, and we're going onto one of the websites that does that, whatever, Market Watch or something, and then hammering at it, basically. And I think a lot of the time as well, they don't understand why something is moving.
Yeah.
It could be for anything of a million things, and a lot of the time, especially with smaller cap stocks, it's probably just the management team trying to push price up to get out of a position, to get out of their position. So it's not a smart thing.
It's not.
No. The other thing I was thinking about when I was actually doing this up was statistics. because people tend to focus a lot on win-loss ratios and all this kind of stuff. And I was going to do mine's around in the mid-60s. Usually it hovers at around the mid-60s. And it's basically, I also think it's probably the most irrelevant thing I know. And the only reason I know it is because the platform tells me. Because it doesn't show what's actually going on in your mind, and doesn't show what's actually going on in your thing. When I had a really high, I was up in the 80s win rate years ago. But I was making no money because the problem is that I wasn't allowing risk in. So I was always getting out very quickly. I was always, I wasn't letting anything run. I was moving my stop up too quickly. So even if you're only getting like 2 ticks out of a trade, it still registers as a win because it is in fact a win. And it was only when it came down to the early 70s, mid 60s, low 60s at times, did it actually start to become like an actual profitable enterprise that you could really do something with. Also as well, it doesn't, looking at your win rate, every time you turn on the spread better, they have that little thing at the top and says 72% of people are profitable or not profitable or whatever over a period of time.
Yep.
So your win rate might be just over a period of time. And then if the market is trending and it just happens to suit you, because really people don't understand the importance of the action that's in front of them, because especially as a day trader, it's not my setups that make the money a lot of the time. It's the action of the day. So if I get it in the right place and then they decide to just push it up. Yesterday was a good thing. I went long yesterday and in the morning time, and I can barely remember what I was trading yesterday. I went long in the morning in the right area, and it went up whatever 4 or 5 points, and then it stalled, and it got stalled in a resistance, and then it came straight back. Well, I got out with my 4 points. I was happy enough with that 4 points, but it came straight back. I was expecting to come out with maybe 10, 15 out of that particular trade, and then double bottom and went again, and then eventually sold off again. So it's, if the action is nice and technical and everything else, it's quite easy to trade. If it's quite bullish but not super bullish, there's a slight tip over in day trading where it gets too bullish almost, because if you're not in a trade at the beginning, it's really hard to enter price when it's moving aggressively up and not giving you a pullback.
Yeah.
So all you're left with then is that you end up then trying to catch a knife, to a certain extent, or whatever. You're trying to, you're looking at areas of resistance to see if you're going to get any sort of reaction to the area of resistance, and that's dicing with death, really, to a certain extent. And like it did it to me yesterday. Actually, there was one point it went up to resistance, and then it didn't break it, and I can't go long if it doesn't break resistance. So like it goes up through resistance, then it pulls back, and then I'm a happy guy. Like, but that was a big thing, anyways. That I decided that, or thought that statistics are, those type of win-loss rate things are not completely junk, but they're really not giving you much of the real story. Like
it's a bit one-dimensional. So it's only giving you one piece of the jigsaw, right? There's a whole host of other data that needs to go in to make it useful. But the reality is, amateur punters are absolutely drawn like wasps to the jam jar around high hit rate trading systems, right, and stuff. And so they love it because they think that's the answer. But as you've explained, that just because you've got 80% plus hit rate doesn't actually mean anything. So sometimes people are a bit surprised when I say, if you can manage to basically, as a swing trader, if you can manage to get to a 50% hit rate and a 2-to-1 average reward to risk, you have great positive expectancy. You have absolutely great positive expectancy. Anything above 30% means you're not losing money. All right. So 40%, 50%, you're in a great place. But it's that old adage of people would sooner be right than make money. That's the fascinating story that keeps coming round. I keep seeing it time and time and time again. People would sooner be right than they would make money and stuff. So,
It also doesn't separate out your setups. So, like you have different setups for different things. I mean, they're basically, like I have one setup which has a terrific risk reward, but it only triggers probably 50% of the time. And I can take up to, I'm allowed 3 stops in that setup. I can get stopped because it's because I'm entering very sharply. I can allow myself to get stopped out 3 times in that without actually having to worry, because if that setup triggers and it goes off, then I'm going to be in there all day anyway. So I don't have anything, much to do with that whole thing. And there's only basically three in my world. There's only three different types of setups. There are the top of range where you're looking maybe for, or the bottom of range where you're looking for support for a resumption of the trend upward. And then there are the top of the range where you're looking for a reversal or a break. And then there are the journey ones, the ones that where that journey is already, because that journey might take 3 days, 4 days. So there's the setups that you're trading are the ones that are the journey between the bottom of the range and the top of the range, and they're all different setups, because if you get in at the bottom of the range and you sit in the bottom of the range and it goes to the top of the range, then you have a great RR. They're different setups. You can't expect the same from them. So you can't expect your high RR setup does not need to have a great hit rate. It just needs to hit occasionally, but really well. So that all those things affect win rate, I think. Anything else written down there? I wrote down, I realized I could get more out of my setups. That was a big thing. I think in some ways I wasn't being quite as efficient with setups as I possibly could be. And then as well as just looking at one of the big things I did during the years, I identified I have down days. Like I had some good, really big down days during the year, and which I wrote about at the time. And then I identified what.
Sorry about that. Everybody's a bit cold. They want the heating on. That's what it is and stuff.
Same thing. I hate putting on the heating during. I hate putting on the heating during the day. It's like this thing. It's even when my wife is home, she puts on the heating, and it drives me nuts. Yeah. Because it feels just too decadent to have heating on in the afternoon. It's just
no, I can understand. Folks are just feeling the cold and stuff there. So and also because we've had guys in and out with work, so the doors have all been open and stuff. So the cold winds coming in as well and stuff. So as I'm sat there in my t-shirt, but anyway.
It's this one time. It's the one day of the week actually I turn on the heat, because I'm sitting up against the radiator right now at the moment. So I switch on the heat for a half an hour before I actually sit down to do this. Just because I don't want to be uncomfortable when I'm trying to think about other things. Anyway, as I was saying, I identified what the common things were with days that were down for me, which I had big down days, which was tired, busy, either are hungover occasionally, which is also the same as being tired a little bit. Then getting into trouble with an early enough trade in the day and letting it run, which I do sometimes anyway. But because I have got there late, I haven't planned out everything as I should do. So I get into the trade, take the trade, let the trade go against me, add at the next area, which I should do. But again, I haven't planned it out properly. And then I ended up taking a big loss. So what I ended up doing was just implementing a more comprehensive self-check before I even start my day's trading, so that I go, were you busy this morning? Were you tired this morning? Were you hungover this morning? Have you planned this out? And then only taking trades. Only taking trades when I reached a certain feeling within myself, that I was calm, was collected, had a plan, I knew what was going on. And the other thing I changed during the year is I stopped trading the first 15 minutes of the day, really, which used to be something that I would do occasionally, but because sometimes it can be you have pre-market action, and sometimes the pre-market action would trigger a trade, and you'd be in there. Have to, but you're as well not to be in it, because the first 15 minutes were chaotic. So I stopped that. I exit trades basically, or I just don't take the trade, even if I'm in it.
Sorry, is that the first 15 minutes of your trading day, or like the first minutes of the cash open, the US indices?
Cash open US.
Right, yeah, okay. All right, that makes sense, because I tell everybody to avoid the first 15 minutes. It's just mayhem. It's mayhem, it's chaos and stuff. You've got no opportunity to really. I don't think you've got really any opportunity to have a long term sustainable edge trying to trade in there, because especially as a retail trader, your spreads are going to be pretty much bigger. Okay, the volatility going in there. Okay, is just. It's not your space. It's like the same after a news event. All right, let the market have its madness. Okay, let it do its thing, and then actually afterwards, then it starts to make a decision on where it wants to go, what it wants to do. That's the time to pick your entry and get at it and stuff. But yeah, I would always say that you give the first 15 minutes miss. It's just you're asking for trouble.
No, because it's not technical. Even if it's in your, like, the thing what used to get caught out with sometimes is that it would just be right there in support, we'll say, and it would trigger at 235 in support, and then I'd be itching to take that.
Yep.
Because it's an actual good setup, or whatever, and it had been. It might be in accordance with what was happening in pre-market, so you're expecting it to go up. So it's one of these journey setups as you're going up, but it's not technical at that time of the day. It's just people getting in and getting out of positions. They're not thinking about it. They're executing orders that are, because if you talk to brokers about how brokers execute orders, like, they just execute orders. That's all they do. They say they don't plan as much as people think.
No, not at all.
I also had some super news days during the year, like where I did really well off news, because but I have no real proper setup for news. It's wait a minute and then hold your nose and jump. That's all you're doing.
Yeah. With regards to news, it's all something I have. I wouldn't say it's something I've always fully committed to. All right. Basically, I don't want to be in front of it. I don't want to be at it. But afterwards, if there's an opportunity, then I've always been happy if it's fitted into my particular routine. But I have noticed this year certain how would I call it? Certain post-news price action events have shown up, all right, again and again. That just allows me to build a small setup around it. But even then, I just, I know there are people who just literally focus on trading news events. Okay, and fair play to them, good for them and stuff and what have you. It's just, I have this, I don't know. I think I mentioned this on a thing I was doing last night. Is that I'm interested in what the news is, but I'm fascinated by how the market reacts to the news. I'm fascinated by how the market reacts to the news. And actually that is we've just talked about having a bias. Okay. I'm actually very, very wary in myself of not bringing a bias, because even if the news is better or worse than expected, how the market reacts is actually the real importance of it. If you just look at it and think, good news, above the news is means I want to be bullish, but then actually it could be a completely different reaction. So, I'm very much about, if I'm going to trade at post-news events, I want to have no bias, and I just want to be open to basically what the market's telling me in that moment, to see how the market is reacting, because what the news is and how the market reacts, they're not always the same thing.
No, and you can't ever know it. I mean, it's trying to guess the mind of somebody else, because the people who actually move the market are going to interpret. It was like Amazon years ago. I remember when I started off trading at Amazon, and Amazon would just come out with another losing year or something. It was never making money, and then the market would just, because it was controlled basically by a few hedge funds, would just act in these completely irrational ways, because the hedge funds decided that they wanted to act irrationally because they're, for whatever reason. But generally, what I tend to find when I'm dealing with news events, you have, like, a lot of the news events happen mid-range, when you're in the middle of the range someplace, or quite low to the top, or quite low to the bottom, or quite close to the top, whatever it is. And you can see, so where the magnets are. So there's a magnet up here, there's a magnet down there. And then a lot of it is just seeing this aggressive move, after the first bar or two. You're not in the first couple of bars, because usually you have a big spike up. We say good news, you have a big spike up, then you have a big spike down, and then you have a big spike up that continues. So you're just waiting for that to sort of get underway, and then or you can use traditional, stuff like wait for it to cross a little trend line or something if you have the luxury of that. But it's not costing you that much. Nobody's saying that you have to be in there for more than three points. That you are taking a risk, but you might have this area that's 10, 15 points above, and it's moving towards there. So just hold your nose and jump in the deep end, and see what happens, because it's not going to cost you a lot. What's it really going to cost you at the end of the day? Unless you're one of those traders who just can't get out of a position and can't handle the fact that they're being wrong. It's and go with a small position size. A small position size also, just to give it so you don't frighten yourself.
Yeah. There are lots of people who do struggle to get out of positions, for being wrong. They're just that loss aversion bias. It's not really a loss until they've closed the position, and so then they've lost perspective. And then it becomes all about hoping that the position turns around for them. And if it doesn't go everything, at least they get out and break even. All right, and they'll get out and break even. Thank the Lord and stuff. They got out and what have you.
Yeah,
and that's just no way. There's no way to trade. There's no way to live your life either. You're just asking for trouble. You're asking for trouble that way.
Turning your day trade into a position trade is kind of stupid.
Yeah. Tell me you're a rubbish trader without telling me you're a rubbish trader. When I see day trades getting turned into position trades, that tells you all you need to know.
The only reason that you could even do something like that is that you're in a long, and then you have this fabulous close, and then you might go, all right, I might let that run overnight now and see, or take 90% off or something, and then let a runner run overnight.
Yeah,
runners are great, by the way. I love runners, because runners, what a runner is, I suppose explain. So you might go in the bottom of ranges, the top of ranges are full position size trades for me, right? So because they're the highest RR, but then once you get a few points under your belt, you have a lot of contracts on, you've go up a few points, get rid of half your contracts, and then you paid your day, you paid for yourself for the day. You have money in the bank that you can use to compensate yourself for any stop loss you might have to incur from now on. So now you're in the most wonderful position that you could ever possibly be in the world, which is wages paid, free trades, not going to cost you anything, and you're in with a high probability trade to the upside, and just sit there and let it go. Just put in, once it goes up a few more points, and move my stop up to better than break even. Sit in your backside. Don't, if you can, possibly don't interfere with.
The Mark Douglas talked about in one of his books about that's what he did, like paying himself, taking a piece off the trade as it went his way. And I think for a new trader, that's not a bad thing. Okay, to take a piece off, because it builds a little bit of self-confidence, self-belief, self-trust. These are the things that nobody really talks about. When you're talking about trading and learning about trading, everybody just wants to talk about setup. Very few people actually talk about the emotion of managing a trade. Okay, in terms of managing your self-confidence, managing your self-belief, managing and building trust in yourself to do the right thing. And so I appreciate that at the start of trading, and I did it myself. Taking a piece off as the trade goes your way is a can help. The downside is that when you're wrong, you are fully sized when you are wrong. All right. Whereas what it means is that your runner has to be allowed to run properly in order to generate enough revenue so that it covers those trades where you are fully wrong. Right. If you're, let's say, just hypothetically, you've got you trade on and it's got three elements to it, and your stop loss is 50 pips away. I'm just hypothetically here spitballing this. If you're taking a piece off at 10 pips and taking another piece off at 30 pips, well, then what that means is, I would look at that personally is that you've got 150 pips of risk with three elements at 50 pips. So I've got 150 pips of risk, and if I'm taking one off at 10, one off at, let's say, 30, so I'm only 40%, so my reward to risk is really quite poor, which means the third element really has to be, it has to run for, 100 plus, all right, okay, almost 200 pips, all right, so that the overall position, the reward to risk on that. So I'm a kind of all in, all out kind of guy. And actually, I'm an all in, and I'm looking to add, if I possibly can, especially on the swings. Not as much on today, I try it, but on swings, there's ways to do it. So it is a good way to build self confidence, self belief. But you just have to realize that there are also limitations to that. Once you have confidence in yourself, once you have confidence in the setup, once you have confidence in that method, well, then you have to look at ways to basically to milk your trades. That's that would be my view on that.
Yeah, I think one of the things with why that works well for me is because, like, I'm really in day trading, right? In scalping, the trade works or it doesn't work. There isn't an in between, really. There are some situations, all right, where it's basing. So you're basing some quick basing on a 699 tick on top of support, on top of a sign, something like that. And there is a reason there why you might open your stop up slightly, because it is a basing period. But in reality, most of the time, the trade either has to go or you're getting out. So the stops tend to be incredibly tight for that particular reason, because there isn't room in day trading. There isn't room for price to dick around too much, basically. It either has to go or your trade's going to fail, or something's going to come in that's going to make you go out. Like I use sine wave a lot, and if I have a bullish sine wave and then quite quickly afterwards I have a bearish sine wave, regardless of the setup, I'm out of there. So it's quite quick. So it doesn't cost a lot, and it doesn't cost me a lot when I'm wrong, basically. So from that point of view, even a few points are going to compensate me for the next trade as well. I also think as well, one of the biggest things that I find with newer traders and runners is that a lot of traders exit their trades too early, newer traders.
Yep.
So what you should do is take the smallest, the prescription I give them is take the smallest position size you possibly can. You like get out of your original, whatever you feel like. Get out of your original trade whenever you're ready. But when you get to a small, or leave a very small position, 1 share, 2 shares, 5 shares, 10 shares, whatever it is, and just leave it there and let it see if it will go to target. And soon after that, when you see that happening and it goes to your target a few times, greed will take over, and you will start to see that you can make more money by sitting on your hands. And that's a way of using a runner to cure. And I think an awful lot of, I think as well, for myself and a lot of day traders, I think runners are FOMO things. You got in, you've made a moderate profit, but you know that the thing can go further, so you're afraid of missing out. So you leave a runner on, basically just to so you get something out of what you ought to be right. Or more often than not actually. I'm generally end up being, I'd say about 50% of my runners actually go anywhere.
Yeah.
So they do. They're not because if the action was busy at the beginning, was quick and aggressive at the beginning, which is usually what you end up. The best trades are quick trades and aggressive trades. So I would keep a higher position size in it. It's when the action tends to be a bit slower. That's when I tend to start peeling stuff off. To protect myself, because if you're seeing it with energy in it, and you see volume coming in, you don't feel as inclined to protect yourself by peeling some off and then just leaving a runner. So it's it's also healthy as well, I think, to have a little bit more stamina to stay in the market, because staying in trades is stressful. I mean, there's the only two things that are really stressful in trading is being wrong and being right. Because when you're wrong, you're obviously a bit stressed, but when you're right, you're also bloody stressed, because you could be sitting there with, I don't know, a month's your former job's monthly income by 2 in a trade, and that's a particular type of stress, because you associate something with that money. Yesterday I was trading away, and I was going, and I lost whatever it was, a couple of $100, and I was like, that's the electricity bill. In a way, and I don't know why I never do that, but it just popped into my head, that I was going, that's whatever, a couple of $100 was that.
Well, that's the thing.
Get a real life connection, which you shouldn't do.
No. But I appreciate it's very easy to sit here and just say, you shouldn't make those kind of connections. But the truth of the matter is, you're human, all right? Everybody does it in a way, but it's one of the reasons why I try and tell people just cover up your P&L if you can. Think of it in terms of units of R, all right? Units of R, okay, rather than the actual physical amount of money, because that's just going to trigger you. It's going to trigger all sorts of elements, and you want to avoid that as much as you possibly can.
Oh yeah, no, absolutely. Because one of the things I think is with trading is that it's like I always think about it's the same as buying alcohol, to a certain extent. Like an awful lot of, particularly I suppose Irish people, I suppose English people too, I don't know, have a different relationship with money and alcohol than they do with money and tins of beans or whatever it is. So I go into, because I used to work in the wine trade and I love like wine, and I go into wine shops sometimes and I see whatever it is, bottle of Sassikai or something, and it's way undervalued, it's way underpriced. And I'll get excited about that and then happily march up to the counter with my €150 in my hand and take my money for a bottle of wine, which is in reality not worth anything near that. In reality, I don't think there's any bottle of wine in the world that's worth more than €100. And because you have that relationship with money and alcohol, and it should be the same with trading, to a certain extent, where you go and you lose your $1,000 or whatever it is, and you sit there and go, oh, you don't have a real life. And I remember the first time I was talking to this Polish guy who was starting to trade. He was actually quite okay, but he was in a very low paid job, and the least he could trade with at the time on whatever it was, capital IG index or something, would have meant that every time his trade would have cost him €20 live money.
Yep.
And that was real money to him. That was that was something he could take that money out and do something with that would make his life immediately better or immediately less stressful. And he I don't know, I fell out of contact with him, but that was a real issue for him. So he was a guy who was intelligent enough, dedicated enough, skilled enough, more or less, at the time, but ran into that thing where he connected the money with, and that just became fear for him.
Yeah, that works on a couple of levels, because the reality is most retail traders are undercapitalized, and this is why, it's one of the reasons why we have seen a huge surge over the last 5-6 years with regards to what they call themselves proprietary trading firms. Okay, they're not like the proprietary trading firms I grew up with, but
yeah.
For the want of the conversation, they call themselves prop firms and stuff. But it is, we've had a huge boom in this because most retail traders were undercapitalized, and then after the ESMA rule changes 6-7 years ago, however long it was, but basically leverage got reduced, that sort of squeezed retail traders. So if you've got 250 quid to start your trading, to start practicing trading, are you going to stick that in a brokerage account, or are you going to spend that on a prop firm challenge that gives you, will give you $100,000 trading account, okay, at the end of it if you pass it? And that's why we're seeing huge swathes of people going down that route. All right, lots of young boys going down that route, and also why you're seeing the huge staggering growth in some of those prop firms, and also why quite a few of the brokers are either struggling or they are having to come out with their own prop firm offerings in order just to compete and stuff. So it's also the industry's changing to try and adapt to that.
It'll also be less painful for people as well, because you've spent the money, the money's gone. You've given the money to the prop firm, so you're not getting that extended pain of getting little cuts all day long. And I think as well, in some ways, the brokers cut their own neck by the sheer fact that they used to be able to go in and trade for 20p or something, whatever it was. It's very small amounts of money, and I think that there was a huge cohort of traders who would go in and do that, and they might take their €200 or whatever and put it into those accounts, and over time lose it. But they can't afford to do that now, because like IG index, the minimum is like 123 or 127 or whatever it is. I can't remember, but they're not going to that quickly adds up. Like you can quickly 60 quid, and that can be your account. And so you're in reality for a lot of traders, they might have €200, but in reality, they only have 6 bullets to fire in the market as of the stop loss that they have to use. So it's too much stress. It's way too much stress for them. So yeah, it makes more sense. Your money is spent. If you win with prop firm, you come out the other side of it and you have, something real, or whatever. I mean, they all try to cut your neck anyway. As I was looking at the rules for some of those things where we talked about it before. Like I was looking at some of the rules for them recently, and wow, it'd be hard. It's for a very particular type of trader can do well in those things.
Exactly, and most do not. The success rates are no different than from with brokers. If anything, they might be a bit worse. But equally, the traders who do well, they do very well for it. So it's about being a good, disciplined trader with a plan. That's what takes you far in your trading journey, regardless of the vehicle. Regardless of the vehicle you work with, whether it be a prop firm or a spread betting firm or a CFD broker, etc., you're being a good trader is more about what you're doing rather than the actual vehicle that you are utilizing to engage with markets.
I'd say in some ways it's actually more difficult with prop firms than it is with just brokers for a couple of reasons. First of all, they put so many rules on top of you.
Yeah. That's true.
That they're setting you up for failure anyway. Like, it's scalpers are really the only people. It's people like me are really the only people who, and there aren't many of us, who are the only people who could actually work in that environment and have a real chance of doing something with it, because they're not really there for swing traders. There doesn't seem to be any prop houses for swing traders as far as
there are, and there are a few people who are doing okay, but the costs, even if they're using a swing trading account with, like, let's say one or two of the bigger prop firms, they're the costs, like the overnight and especially over weekend swaps and stuff, they make a real dent in the account, in your trades and stuff. So you have to be aware of that and manage that as part of the way you operate. But the landscape has changed. Okay, the landscape has changed in terms of the route into markets for new traders. And like all of these things, for some people it'll be a threat, for some people it'll be an opportunity. And I really think for all traders, it has to be how do you turn it into an opportunity? All right, there's plenty of opportunity in markets. There's plenty of opportunity, plenty of ways to skin a cat. It's about how do you turn it into an actual opportunity for yourself.
Yeah, I'd also think as well it'd have to have a higher failure rate than just even spread bettors, which is an atrocious failure rate, because you can sit. You have two things. You have the luxury of time with spread betting, so you can sit there and wait for a week or 2 weeks for your absolute perfect setup to come along. If you're starting off, because one of the things that I would say to a newer trader is that you take your very best setup when you're going live, and you wait for just that setup, even if you have to wait there for half a week or whatever time, and then just do that one setup and get yourself in going, that way, because that's and execution exactly the same way as they would execute in simulator. So they have the benefit of time, and the benefit of being able to pick it up and put it down. Which you can't do with so much with prop houses. They want you in there in the market. So, you're busy for a week and then you're funded or you're not funded, and that's it. Because you can go, which is how I trained myself, is that I used to go to the market with a specific amount of money that I was allowed to lose for myself. And that's, I could, was 200, I think was the amount that I used the very first time. And then I go in and I'd lose my money eventually. Every time it took me longer to lose the money. And then I could go in and take what I had learned from that and try and, get better for the next time, and go in and get better for the next time, and go in and get better for the next time. It's and it took quite a few tries to actually for before I went, when I went live one day and didn't not go live again, basically. Well, I didn't go back to the simulator again, excuse me. Flus are terrible things. They just keep going forever.
Well, yeah, true. True. Well, listen. I think we've jabbered away there for a bit and stuff, but I suppose just a couple of points. I have yet to do my full review, but I know things that have come out for me is that I wasn't heavy enough on the Trump trade. Okay. I saw it, I called it, alerted people to it. I took pieces of it, but was never as heavy as I should have been. But that is trading. You're always too big when you're wrong, and you're too small when you're right. That is, welcome to trading. And if I look through my trade results for like months and quarters, etc., is that the size and conviction is not as big as I want it to be by the end of this year.
Yeah.
And so that's kind of one of my learning points and stuff I've got to take away. I still have a very love-hate relationship with Swiss franc. Okay. That just comes out through my records. Is that me, or is that just the shenanigans of the S&B? Who knows? But it seems to be a recurring theme that happens. But on the flip side, I remember, I love sterling. All right. I love sterling. It's where I started. It's where I still go through and I still work it. One of the other things that I kind of have enjoyed this year is that I've actually done much more short-term trading than I would normally do. And in particular, sort of very aggressive 1 minute and 5 minute trading on US indices. And I've enjoyed that. I haven't done as much of it as I wanted to in the last month or so because of just life stuff going on. But I've actually really, I've really enjoyed that. All right. I have really enjoyed it. It's almost like, how can I describe it? It's almost for me like playing a computer game in the sense of, I get pleasure out of pushing the buttons and doing that and stuff. I don't look at it in terms of trading. It is like kind of, it's almost like a release. It's like playing a game. But then on the flip side of that, my other things that I've loved and as I've seen through is 4-hour charts. All right. As the kind of short-term swing trader in me loves those 4-hour charts. Okay. And sometimes it can be frustrating to have to wait a few days to get the setup that you're looking for. But as I was saying earlier, it's about attracting a good trade to you, not chasing it. All right, now when you chase it and stuff. So there's just a few things that I have just as I've been starting to get towards doing my own review, themes that keep sort of popping up, and I'll as I go deep into my data. I'll have a look at that. Okay, over the kind of my Christmas New Year break, as we said last week. Even if it's not trigger time, you can still be working on your business. All right, still doing work to help you going forward next week. And one of the interesting things is that, and one of the things I wanted to share about is just to basically as to why I try and get people to do it is so. One of my ways of operating is, in particular, being intraday. Sterling trader or sterling pairs predominantly at the start of the day, and the interesting thing is that has gone well, and I've enjoyed that, the kind of more aggressive elements of that. But this is why I try to get across to people is, and whilst doing that and collecting data for it, it has also opened up two other opportunities for me, because you spend enough time looking at certain charts of certain instruments at certain times doing certain things, you start to sort of pick up indications of other possible opportunities. You start to think, well, hang on a minute, why does this keep happening at that time every morning? Why does this keep happening? And then you're into like, well, okay, is that just a time sensitive element? Is it me seeing more than is there, or is there actually a genuine opportunity there? And that's what I'm working on one at the moment. So basically taking that from there. And so the reason I try to get across is that, that's why, doing a little bit every day, just you don't know where it'll take you. Okay, you don't know where it will take you, and sometimes your best opportunities start to come out of other trades, whether they be rightly or wrongly, and that is actually it's a fringe benefit. All right, it's a fringe benefit of having a good routine, doing your analysis, working at your trading, starting to sort of see things and think, well, hang on a minute. This keeps happening. Now, we did a bit of back testing. This is where now, like, right, okay, can this dog hunt? Do I need to do a bit of work on basically seeing if this is a genuine opportunity? A lot of times it isn't, but I actually start thinking, well, hang on a minute. This has come out of my just doing the same thing. I have that consistent effort, and then you start to get to see all these other opportunities come out of the back of it. So, that's one of the things that have been pleased. That's one of the things that's been good for me and stuff in terms of that I'm going to be taking away and working on over the next couple of weeks.
It's one thing that when you're saying there about computer games, because it's one of the things that people don't understand about scalpers or intraday traders. You know, they come up and they talk to you about where do you see the market being in 6 months, and I'm like, I don't fucking know. I have no idea. And the thing is because effectively my job isn't trading. There's no fundamentals in it. It is video game playing. That is what it is. Yep. And effectively, I sit there and play a video game on all day long, or well, for the couple of hours that I do trade. It's also what, you know, the thing with patterns, because there are naturally patterns, because things are done by the same people, yep. And it's done the same ways and sort of along the same lines all the time. Yep. And it's professional traders, and then other professional traders see the same pattern happening, and then they go in and replicate it themselves. They go in and trade towards it. And it's actually how when you're trying to say to people sometimes that sometimes a lot of time trading isn't that stressful, it's because you have passion. So for me, it's the bottom of the range, right? That's the bottom of the range. Going long is my best and favorite trade, and I just sit there. It comes to its area where I can start taking longs, and then there's nothing to do. You just sit there and wait for your trigger, which is a predetermined way of entering trade. Like, it's a mechanical thing. So you have to go 1, 2, 3. There's a trend, there's a low stochastic that's in favor of your trade, that's going to support your trade. Sine wave support. For me, I like sine wave. You can use PSAR, do exactly the same thing, really. It's just not as pretty, but PSAR will do the same thing in a quick time frame. And it breaks the trend line. And that's it. So there's no stress. There is no real stress in it. And then you just have to, you put your stop in, which is the initial stop is the previous low, and it works or it doesn't. There's no, you don't have to be that emotionally involved in that particular trade. Actually, that's the of all of them. Is how much can you leave this alone is really the only emotion.
Yeah, exactly. That's a good point for us to draw a close. So, listen, we said this is our last one for 2024. I think we'll be back. Is it second week of January? Okay, be the sort of, is it about the 9th, 8th, 9th, and stuff like that. But we'll put that details out. But listen, just to say to everybody who's listened through us this year, it's almost about a year, all right, since we started, isn't it? So it's a case of. Listen, just thanks to everybody who has basically subscribed, who's basically liked, who's basically messaged us, whether it be right or wrong. Okay, maybe they've contradicted our thoughts, or maybe they've loved it. That's absolutely fine. But difference of opinions is what makes a market. We have no issue with that whatsoever. We kind of enjoy it. But listen, thanks to everybody who's joined and listened. Okay, and hopefully we'll be able to do more of this in the new year, and also we'll have a couple of TOGS trading podcast socials. I said we'd sort that out. That's one thing I will do over the Christmas period. We'll get some dates for like a London one and a Dublin one there. So listen to all of you wherever you are in the world, because once again, I appreciate we have a global audience these days. Listen, I hope you enjoy, whether you're here enjoying Christmas or whether you're your own season's greetings, wherever you may be or whatever you might be doing. But listen, we hope that you have a great end to the year, and that 2025 year is a year full of health, happiness, and prosperity in the form of pips on a regular basis. Anything to add to that, Ian?
Not a bit, except Happy Christmas.
Yeah, there you go. Yeah. There you go. All right. Well, let's leave it there. Thanks very much, everybody. Have a great Christmas. Okay. Enjoy yourselves. Enjoy that time with the family. That's what we talked about last week. And we'll see you in the new year. And let's bring on 2025. Fabulous. Cheers.
Bye.